Hello guys and welcome back to my YouTube channel ACCA and beyond. So we are going to be continuing chapter number 5, which is about risk. We left off at performance materiality in the last video, and we are going to be continuing with risk assessment procedures. Yeah, so let's get started. The auditor must perform procedures to identify and assess risk of material misstatement. These include inquiries with management, internal audit, and other relevant personnel with the entity. Analytical procedures are also performed to identify unusual trends or relationships. In addition, the auditor may observe control procedures and inspect important documents such as policies and strategic reports. Next, understanding the identity. The auditor must gain a clear understanding of the business and its environment. This includes the organizational structure, where a more complex structure increases the risk of misstatements. The auditor also considers ownership and governance, including the relationship between owners, management, and those charged with governance. The auditor must also understand the entity's business model. This includes how the business operates and the extent to which it relies on IT systems. For example, the entity may use multiple outdated or poorly managed IT systems. This increases the risk of material misstatements. Similarly, if IT systems are outsourced to third party providers, this can also increase the risk and must be considered carefully. The auditor may also look at industry regulatory and other external factors that may impact the business. In sorry, yes. Uh, in addition, the auditor considers how the entity measures its financial performance both internally and externally. The applicable financial reporting framework must also be understood. Uh, yes. The auditor evaluates whether the entity's accounting policies are appropriate and consistent with this framework. Another key area is the system of internal control, including identifying any or all control deficiencies. All of this understanding helps the auditor assess inherent and control risk at both the financial statement and assertion level. Based on this assessment, the auditor can help design appropriate audit procedures to respond to the identified risk. Okay, so now let's move on to analytical procedures. So analytical procedures involve evaluating financial information by analyzing relationship between financial and non-financial data. The auditor looks for unusual fluctuations, inconsistent relationships, or amounts that differ significantly from expectations. These procedures are a fundamental part of the audit process. They are used during risk assessment to help identify potential problem areas. Analytical procedures help the auditor spot unusual transactions, trends, or ratios that may indicate a risk of material misstatement. Um, they are also useful in identifying possible fraud and in highlighting areas the auditor may not have been uh, uh, previously aware of. To perform analytical procedures, the auditor compares the entity's financial information with different benchmarks. This includes comparing current figures with prior periods, budgets, or forecast, and the auditor's own expectations. The auditor may also compare the entity's performance with the industry data or similar business. In addition, the auditor looks at relationship between different figures. For example, revenue and receivables are purchases and payables. They may also compare financial data with non-financial data such as payroll cost with the number of employees. Data analytics can be used to perform analytical procedures. For example, audit software can extract data from the client system and compare actual result with budgeted figures. Analytical procedures are used at all stages of the audit. First, the preliminary stage. Uh, the preliminary analytical procedures are performed during the planning stage. This helps the auditor understand the entity and identify risk of material misstatements. Next, analytical procedures can be used as substantive procedures. In this case, they are used to directly detect misstatements in the financial statements. Finally, analytical procedures are performed at the completion stage of the audit. These are used to assess whether the financial statements are consistent with the overall audit strategy. In modern audits, automated tools and techniques are increasingly used to perform these procedures more efficiently and accurately. Now, about these ratios, they are very important for your audit exam, for your FR exam. Equally as important, maybe you can say for your FM and your PM exam also. So, I am going to prepare an in detail video about these ratios. So, it's clear for once and for all the formulas and the meaning behind these ratios. So, for this video, I'm going to skip them and you can watch that video of mine through my channel. And I'm also going to skip this example. Okay, so let's start from here. Okay, so audit risk questions are very common in exams. When answering, always think from the auditor's perspective, not the client's. So you always have to think from the audit perspective rather than the client. It's you always have to detect the audit risk, not the business risk. Okay. The auditor's objective is to detect material misstatements in the financial statements to avoid giving an incorrect opinion. They are not concerned with the profitability or performance of the business. They do not write about business risk. A common mistake students make is explaining business risk instead of audit risk. Marks are only awarded for audit risk, so the answer must always relate to possible misstatements in the financial statements. For example, if customers are struggling to pay, the audit risk is that receivables may be overstated if recoverable debts are not written off. If the client operates in a fast paced industry, the audit risk is that inventory may be overstated if it becomes obsolete and is not valued correctly. If revenue is falling and cash flows are negative, there may be a going concern issue. The audit risk here is that adequate disclosures may not be made in the financial statements. In the exam, always clearly link the scenario to the financial area and explain how it could be misstated. To properly explain an audit risk in the exam, you need to follow a clear structure. First, identify the financial statement assertion affected, such as valuation, completeness, or cutoff. And if you have problem in this area, I have also created a separate video for this. This is a area which I had a lot of problem in understanding during my audit paper. So I've made it, guys, a bit simpler for you, so you can watch that video on my channel. Second, clearly state the specific area of the financial statements affected. For example, say trade receivables are overstated or allowances of receivable is understated. Avoid vague statements like assets are overstated or profit is overstated, as these will not earn marks. Third, explain the direction of the misstatement, whether the balance is overstated or understated. Only using the term misstated, it's clearly possible that it could be either. Finally, link the risk to the component of the audit risk, such as inherent risk, controlled risk, or detection risk. Now, the auditor's responses to risk. Once a risk is identified, you must suggest a relevant audit response. The response must directly address a specific risk identified, not just a risk in general. For example, if customers are struggling to pay, there's a risk that receivables are overstated. A relevant response would be to check after date cash receipts to perform whether debts have been paid. Another appropriate response is to review the aged receivable listing and discuss doubtful debts with management. However, simply checking the arithmetic accuracy of the receivable listing is not relevant as it does not address valuation. Similarly, sending receivables confirmation only checks existence, not valuation. Suggesting improvements in credit control is also incorrect, as that is not management action, not an auditor response. Uh, Second, if the client operates in a fast paced industry, there's a risk that inventory may be overstated if obsolete items are not written off. A relevant audit response would be to obtain the aged uh, sorry. Okay, so a relevant audit response in this scenario would be to obtain the aged inventory listing, review old or slow moving items, and discuss with management whether a write down is required. Suggesting that the company should discuss inventory to sell it is not a correct option, as this is management action, not an auditor response. Similarly, uh, simply attending the inventory count only confirms existence, not valuation. To make it relevant, the auditor should attend the inventory count and specifically look for older or obsolete items that may need to be written down. Third scenario, where revenue is falling and cash flow forecasts show a negative uh, cash flow. This indicates a potential going concern issue, and there is a risk that disclosure may not be adequate. A relevant, sorry, a relevant audit response would be to assess the company's ability to continue as a going concern by reviewing management's forecast and evaluating the reasonableness of the assumptions used. On the other hand, analyzing past performance alone is not sufficient, as it does not provide evidence about future viability. Similarly, focusing on profitability can be misleading, as profits do not always reflect cash flow position. Calculating liquidity ratios may help identify issues, but on their own, they are not enough. Further procedures are required to properly assess the company's ability to continue as a going concern. Okay, so I think we have ended this chapter. If you have any doubts, please feel free to comment down below in the comment sections. I'll answer as many as possible if you comment. And yeah, and again, one question, if you could just help me out with it. You may have, if you are following my revision series, you may have noticed in the first three chapters, my explanations were a little long. After the fourth chapter, I think I've made it a little brief. So, which method would you guys prefer? Should I make it a little long, explain in deep like I did in the first three chapters, or you just want to keep it to the revision to the point, like I have done in chapter number 4 and 5? If you could just comment it down in the comments, it would be a great help to me. And if you like this video, please share, like, and subscribe. And thank you so much for watching.